I am Deborah Jenkins. I am the research assistant for the Paula G. Carter Center on Minority Health and Aging. And I see a colleague.
Oh, Glenda Beecham Kane.
Miss Glenda, come.
Glenda Beecham Kane, I'm the community outreach worker.
Before I transition over to our presentation today, I want us to be aware and acknowledge that April, of course, is National Minority Health Month. And they have excellent themes, but this theme really caught my eye because it captures the essence of the work of extension. And basically, National Health Month is a time to learn about health status of racial and ethnic minority populations in the United States. And the theme for 2018 is partnering for health equity, which highlights partnerships. And that is so key to have partnerships at the federal, state, and local level. And it is truly an essence of Extension's work to establish those partnerships, to go out and to do effective community outreach of our programs, whether they are youth programs or whether they are senior programs. And one partnership that has really stood the test of time, that has really been there for the Paula G. Carter Center, is the Missouri State Office of Minority Health. We have been with a partnership with them for 21 years, and I think that, deserves a big round of applause for that. That's no standard. Because partnerships can come and go, but 21 years is a long time. Now it's time for me to transition into our presentation on reverse mortgages. And I know even around the state, you're seeing the various different TV ads, and they use really well-known celebrities to promote about reverse mortgages. Well, guess what? We have the experts here to tell you the do's and the don'ts and in regards to reverse mortgages 101. I am going to introduce Miss Melissa Washman, and please bear with her because she injured her foot, and she will be presenting sitting down. That's why, and in support of her is the HR administrator, and Miss Kelly Berger will be co-presenting with her as well. Miss Melissa Washman was born and raised in Columbia, Missouri. She is married with 2 children. For fun, she enjoys spending time with her family doing anything outside near the water. Ms. Washman has worked in banking and mortgage lending for 11 years. She states her work is very important to her because she truly cares about her customers. I quote, "It's extremely satisfying helping people reach their financial goals, and I take pride in being someone you can trust and count on," unquote. Ms. Washman has experience in retail banking, traditional lending, and reverse mortgages. She has found reverse mortgages the most enjoyable due to her love of helping people and results she has seen with the program. I quote, "I love what I do, and I would love to help you too." Please welcome, without further ado, Miss Melissa Washman.
Thank you so much for having us today. We're excited to help you guys better understand reverse mortgages and what they really are, how they work. I actually wrote that bio back when I started with reverse mortgages. I've been in banking and finance now for about 15 years. Before working at our company now, reversemortgages.com in Columbia, I served as many different positions with US Bank here in Jeff City and in Columbia. So I have a wide understanding of just products that are out there and how they compare to options you have with a reverse mortgage. I find that to be very helpful. And I do have 2 kids, Addie and Logan, And I really enjoy the reverse mortgage program. I had an elderly father. He had me when he was 48, and I took care of him through his last chapter of life. And going through that with him, I found that the reverse mortgage is such a helpful tool that can really make a difference when you're going through that for your kids and for you as a senior, rolling with the punches of life and what happens. So I find this to be very enjoyable. And hopefully today we can understand it in a way that you really understand how it works. So, great.
Hi, I'm Kelly Berger. I am the Compliance and HR Administrator for ReverseMortgages.com. I've been with the company for about 7 years now. I started as a loan officer, so I was a loan officer for a few years. I then went into training our new loan officers, and I found a passion in teaching all of our loan officers to then help and assist our customers that we have. I'm still doing that, so I still train all of our new loan officers that work in our office in Columbia, as well as our remote loan officers, so that's something that we've been doing too. I also help in HR administration with onboarding of new employees, and I help with talent acquisition efforts. So we go to universities and colleges all around Missouri and surrounding areas and educate people as well as college students that want to be in the industry. So that is who I am.
She does a little bit of everything.
Yeah, jack of all trades. Okay, so we're going to go ahead and get started. We're really excited to be here today. When they reached out and said, we have people who are interested in hearing about reverse mortgages, that was so amazing to me. I was like, yay, we get to share our passion, go and speak about this wonderful program, and we are just absolutely thrilled to be here. So we will have questions at the very end, so make sure you're writing down your questions and having those. So at the very end, we're happy to answer anything. If we run a little over, you have Melissa's business card in all of your folders, so feel free to reach out to her and ask anything else that you have that we can't answer today. Okay, so we're going to go ahead and get started. Okay, so reversemortgages.com. Just to give you a little bit of information about our company. We are in Columbia, Missouri. If you're familiar with Columbia, we are off of West Broadway, kind of over by where Shakespeare's and Truman's and Hy-Vee is, over in that area. Our mission statement is to offer senior citizens the ability to live in their home and experience the freedom of financial security. That is something that we worked on for years. When we were creating reversemortgages.com, management, HR, a bunch of us met together and were like, what is going to be our mission statement? And we really put a lot of effort into that because we wanted to make sure that we were explaining to our customers and future customers exactly what we want to do. And that is to help our seniors and our customers to be able to live in their home and to have that financial security. So that is our mission statement. We strive to reflect the following core values. So we urge all of our loan officers, all of our employees to make sure that they are living these values every single day, not just in work, but also in their daily lives, that they are ethical. That is first and foremost the most important to us, that every single person that works for us is an ethical person, that they are efficient, that they are knowledgeable and team-oriented. So we have a wonderful group of 70 employees who are extremely passionate about what they do, and we all have the same common goals. So Melissa can speak a little bit about that.
Yeah, and I do believe truly that everyone that works there really wants to do the right thing in the right way. Everyone has a lot of experience coming from another, financial institution into our group at Reverse Mortgages. It's a lot smaller, in comparison to U.S. Bank being a national bank, but I was very impressed with the people that work there have a lot of experience, many, many years working in traditional mortgage lending and finance. So there's a lot of knowledge there that really is beneficial to our customers because they will give them the best advice they have. Even sometimes if a reverse mortgage is not the right fit for them, they will tell them that because it's important to us. The way we grow our business is by treating people right, doing the right thing, and then having that come back to us. We've done well with that. So everybody's knowledgeable, we do the right thing, we partner with the right people. Of course, we have to have appraisals done, we have to have title companies. Through many years of experience, we've found the right people to work with, to partner with. And then we're all team oriented, so that's another nice thing. When you do a mortgage loan or anything, you don't want it to drag on forever. You don't want to have all these things where we say it's going to be this way and then it turns out to be a totally different situation. So, all of us working together to do our part that we are specialized in, and you know it like the back of your hand, it helps to be a good experience. I have a lot of feedback from my customers. I get a lot of thank you cards and notes where they say, this was so easy. It was like you said it was going to be. I felt like I was involved, each step of the way in the loop, knowing what's going to happen next and what to expect. So I think we all work together to do that.
Okay, so what we're here to discuss today is what is a reverse mortgage. A reverse mortgage, there are a lot of different reverse mortgages out there, essentially. There are proprietary products, there are products that the county state offers, but the main one that you hear about on TV and that you read about, and the product that we offer, is called a HECM, which is a home equity conversion mortgage. So a HECM is a unique type of loan that allows homeowners to use the equity in their home to eliminate monthly mortgage payments and or supplement their income without having to sell their home or give up title.
And also, HECM is the FHA insured reverse mortgage. Any other type of mortgage would just be a private reverse mortgage that somebody is, lending on their own, privately insured. The way I explain reverse mortgages is a little bit more basic. I'm not a public speaker, I'm a loan officer, so I'm used to working with my customer one-on-one and trying to make sure they understand it in just basic terms. And what I have found is the easiest way to describe it is just to think it's a mortgage loan. And what is a mortgage loan? It's when you borrow money from the bank is going to get paid back that money plus interest, and it's secured by a lien on your title to say you have a loan. It's safe for the bank because you can't run away with your house, and we're going to get paid back. The difference is this loan is for people who are 62 and older. And rather than having an agreement with the bank that you're going to pay back this loan little by little each month, like a regular loan, this loan will sit there and it gets paid back in the very end. And we'll explain what the end is in a minute. But there's no monthly payments. So it's a win-win. It doesn't matter to the bank whether they're getting paid back in little installments, for 30 years monthly, or they get paid back in one lump sum. But for the senior, it's huge because of your budget, and that mortgage payment typically is one of your largest bills. So being able to have that in your hands and not be paying it out to the bank to repay this loan makes a big difference on your budget, and it gives you peace of mind in knowing there's never going to come a time where you can't make that mortgage payment. And that's kind of what's scary when you're on a fixed income, is just worrying, going and taking out a loan that you're agreeing you're going to pay that back no matter what every single month. And just knowing that you don't have that on your shoulders, so.
Okay, when is a reverse mortgage right for you? So these are the top 6 reasons a reverse mortgage is good for somebody. You could eliminate mortgage payments, which is what Melissa just said, as far as getting rid of that mortgage. Subsidizing healthcare, lifestyle enhancement, supplementing income, home improvements, and helping family members.
And we talk a lot about eliminating mortgages. So if you have a current mortgage loan, the money you qualify for first, the amount of money that there is has to first go to pay off any existing mortgage loans. If you don't have one, then there's just the money there for you to do what you want with. You can receive it as different ways, and we'll go over that in a minute. But that's one thing. So if you have a mortgage, we can get rid of that. Healthcare, and another thing people will use it for is sometimes to pay for to stay in their home. You could use the money to pay for a private nurse to come in and help if you want to stay in your home longer. That was something with my dad I would have found helpful from time to time. He'd fall and need, I couldn't pick him up, and I'd need someone just to come a couple times a week and help me with showers. Some little things, but that's expensive. And it wasn't like every time he fell, I got a bonus, to pay for it. So it would have been really beneficial to be able to pick up the phone and say, hey, can you move, $5,000 into his checking so we can just pay for this situation. Other thing is, enhance your lifestyle. You're still young and healthy enough to get out and do some things. It would allow you to do that, sometimes make memories with family and travel, see family. Supplement your income, one of the options with that pot of money that you qualify for, some people choose to receive it as a monthly check where it's deposited into your bank account each month, just like Social Security. It's not taxable income, so it's not going to mess up any of your other, forms of income. So it feels like income, even though it's loan proceeds, and that just goes in there. It's very flexible on how long you want to receive it. There's anything from 1 month to your lifetime. And that amount is just like a regular mortgage. If you got a 30-year mortgage, the monthly payment's less than if you did a 10-year mortgage. So it works in the same way in reverse. The longer you have it, the smaller the monthly payment. So we'll get into that later. Home improvements. If you need home improvements on your house and you don't have the cash to pay for it, we always say in finance the best way to pay for it then is to use the equity, just to take it out and basically put it back, because you're taking the money from the home to do improvements, but you're putting it back into it and increasing the value of the home. So that is the best way if you don't have the cash to pay for it. And then helping family members. We hear a lot from our customers that they want to help their family while they're young and could use it. A lot of times they leave, you pass away and you leave money to your children or grandchildren, and they've kind of made it through the rough part, they're settled and doing well. And so a lot of them will say, I want to be able to pay for my grandkids' education. I want to be able to help my kids on a down payment on a home or pay for a wedding. This would give you the ability to do that in a way that wouldn't put you at risk, where you've borrowed money and you have a payment, that kind of thing. So there's a lot of different uses, but those are probably the most common things that we hear.
Okay. Another thing Melissa and I were talking about too that we have seen more of is what they call a sandwich generation. What that means is that people in their 30s, 40s, 50s, are supporting two-family households, essentially supporting their parents, as they've had more medical and health issues that have arose and they have limited income. Their children are essentially supporting them in their home, but then also supporting their own household, paying for their own children, paying for their own families. So they're in this, what's called a sandwich generation, where they are paying and supporting two homes. And we talk to people all the time that are in that situation, where seniors are like, I want to get my independence back. I don't want to rely on my daughter or son to pay my bills. I want to relieve them of having to have that obligation. So I'm going to do the reverse mortgage so that I can pay for my own medical expenses. I can utilize the equity, which is savings in my home, the largest form of savings that a lot of people have. I want to take it out, and I want to be able to use it so I have that financial freedom again and lessen the burden on them. So we do see that a lot more, it's common. And so there's so many different reasons. It's not always a dire need like what we're talking about. Sometimes people are just like, I want to go on a vacation. I want to travel. I want to see the world. I want to do whatever. And I don't want to use my savings. I don't want to use all this other money. I can utilize my equity and go travel and go do whatever it is I want to do. So there are many different reasons that people do a reverse mortgage. Do I qualify? How do you qualify for a reverse mortgage? Well, there are just a few basic requirements. One is you have to own your house. You can't be renting. You have to truly hold title. You have to live there as your primary residence. What that means, you can own multiple homes, that's fine, but you have to live there for at least 6 months and 1 day out of the year, okay? That's what your primary residence is. You have to qualify under FHA's financial assessment. You have to be at least 62 years of age, and you have to have sufficient equity in your home or cash to bring to closing, essentially. And Melissa will explain those a little bit further.
Yeah, I think the first two are pretty self-explanatory. You have to own your home, and you can have a mortgage, but you can't be renting, and it can't be, a family member's home. Like if you're living in it, you'll have to, if you're not on title, become on title. Sometimes we have situations where somebody may have inherited the home from a family member, and their name's not actually on the title yet, and so we can help with that process as well. Financial assessment. This loan, we do not look at credit score per se. It's not like a regular underwriting process. We want to just make sure that you have the ability and willingness to pay your taxes and insurance. So with this loan, there's basic, you can't really mess it up. The only thing is live in the home and then pay your taxes and insurance and HOA dues if you have those. So we want to look at your history to see if in the past you've been able to keep up with your taxes and insurance for the last couple of years. Now, if there's a one-off situation or extenuating circumstance, we can overcome that. We can usually write a letter saying this is what happened. But in general, that you're able to pay taxes and insurance. And the ability is the income portion. We want to make sure that if it's realistic after you pay your current obligations, that there's enough money left over for you to be able to pay taxes and insurance. So most people don't have, a difficult time doing that, because when you look at those stretched out over 12 months, it's not a huge amount of money. And then it's sufficient equity in your home. We'll go over here in a minute how it determines how much you qualify for, but we need to make sure that the amount you qualify for is enough to pay off your current mortgage if you have one. So there is a limit on how much they'll let you borrow, because this is a loan, it's still your house, and they want you to keep equity in it in case you do decide you want to sell your house and downsize or do something else someday with the money. So there's a maximum loan amount, and that maximum amount just needs to be enough to pay off the current mortgage.
Okay, and just to kind of go over that financial assessment again too, like Melissa said, there is not a minimum credit score. Basically what we're gonna look at is just to make sure that after all of your monthly obligations are paid, all the income that's coming in every month, and then all the monthly obligations that you were required to pay. After that, will there be enough for living expenses, where there'll be enough that after this reverse mortgage, you truly can pay your taxes and insurance? We want to make sure that this is a financial solution that puts you in a better place and not something that will hurt you or jeopardize, home ownership and things like that down the road. So it's just a way to make sure that you truly can afford all of your monthly expenses and continue living in the home payment-free, okay? Okay, approved properties. So this is a government-insured loan, and just like any FHA loan, there are HUD-approved properties. There are HUD requirements. It's pretty easy though. Most properties qualify. Single-family homes, which is your traditional stick-built, regular single-family home. 2 to 4 unit homes are fine, as long as one unit, you occupy it as your primary residence. So if you live in a duplex and you occupy and live in one side and you own it, the other side could be rented out, that's fine. FHA-approved condos. So if you live in a condo, we just look up on the HUD-approved site to just make sure that the condo you live in is approved by HUD. Manufactured homes, so single-wide, double-wide manufactured homes, those are approved. And townhomes are also approved. So pretty much most things.
And I feel like that's pretty straightforward, just which properties would qualify.
One of the things that we see sometimes is repairs. That's a question we get asked. Right?
Yeah.
And Melissa can probably comment on that after speaking to borrowers about some repairs.
Yeah, as far as repairs go, they want to make sure that FHA wants to make sure if they're insuring a loan to help you stay in your home, that they're not insuring something that's not safe for you to be in. So when they look for repairs, they're looking for major safety or soundness issues. Like I've had people where, they might have black mold all over their basement. Or I've had an appraiser go in and there was a hole in the ceiling. They could see straight up, into the sky. Settling or foundation, like, if it's truly structurally unsafe to be in. So those are things that, people worry, they think, do I have to paint my house? Do I have to do these things? They're not looking at cosmetics. It's just to make sure that if they're gonna back the loan and keep you in your home, that it's safe for you to be in. And if not, there are options. One of the benefits to working or going through a reverse mortgage at our company is you would be working with me and we would talk about your specific situation. If there was a concern like, well, I've got this issue, what do you think? Or something shows up on the appraisal, we're in communication with you to talk about the options. Sometimes we have the option to go ahead and let you close on your loan so you have some money to get the house, to get things fixed. And then we hold part of it aside, the amount it would take to fix it, until we know it is fixed, and then release that. Other times, there's companies that'll come and do some work and agree to get paid at the end with loan proceeds. There's lots of options, but the main thing is we just talk through it, with your particular case when the time comes.
okay, how do I find out how much I can receive? So, how much money am I going to get with the reverse mortgage? Well, it's based essentially on 3 different factors. Age, so age, that's a big one. Interest rate, what the current rates are, as well as the value of your home. Okay, you are able to take up to 60% of your funds within the first year. So out of all the money you qualify for, you can take up to 60%, sometimes more, in the first year. And then there will be sometimes an additional amount that you can receive, a year after. And Melissa can kind of explain that a little bit more.
So as far as age goes, we know you have to be at least 62, at least one of your spouses. If you're married, just one of you has to be at least 62. The older you are, the more they'll let you borrow. And if you think about it, it's safer to give somebody who's 90 years old more equity in their home, because chances are they're not going to be wanting to next year sell the house and downsize and buy another home. So we don't feel like it's as necessary to leave a chunk of equity in there for them to do something different. If they want to borrow majority of their home, that's fine. Somebody who's 62, they have a lot of life, God willing, left in them, to be able to do something else. So they want to reserve more of the equity. And a very important thing that I found people are confused about is they think the reverse mortgage is some program that they're agreeing they're going to give their house to the bank when they, when this is over. They're just signing up, you can have the house, I want the money, we're done. That is not the case. This is like any other mortgage loan. When the time comes, the payoff balance, you sell your house for what it's worth, you pay off whatever your payoff balance is, and the rest is yours to keep. So that difference in what you get and your home's value in the end is yours. So at 62, they want you to have more. We don't want you to do something at 60 that's going to put you in a position for the rest of your life that you can't do anything, you're overfinanced. So it kind of grows with you. The older you get, the more you can get. And there is an option when we start going over different ways that you can set it up. There is one option that grows with you, that it releases more money as you age. So it's all about proportion and keeping you in a safe position where, yes, you have some cash, but you also have, a lot of money that you have in the house too. So that's how we call it. The age that's what that determines. Interest rate, interest rates change with all loans. You're not locked in until you actually sign your application. So we can't control that. Interest rates right now are still pretty good. People talk about them going up, but nobody really knows. So it's just important that you get a quote, and I'm always happy with no obligation. If anybody ever wants to call me or email me and see what it would be, I can do it every day if you want me to, give you a new one based on interest rates. At our company, though, we are fortunate that we do not spend money on those fancy celebrities, or we don't give out gifts for calling and inquiry. That's where we put our money. We put our money into making this the best it can be as far as price goes. The interest rate, we don't raise it up. We just go with whatever par is. And then fees as well, which we'll talk about in a minute. But that's where all of that extra money goes for us. And then value of home, that's an appraisal. Another thing that's unique with our company is we pay for that up front. A lot of our competitors will ask you to send in the money for the appraisal or a credit card to put on hold. We pay for that up front so that you can truly go from not having a reverse mortgage to having one with no money out of pocket. And so that's what we do. For the value of the home, we use a local FHA appraiser, and that is something that now is regulated across the board. Any financial institution that does an appraisal has to use a third-party appraisal management company. So it's not somebody that just works for us or anything like that. It's a professional local appraiser, and they would come and give you a full, appraisal. We'd show it to you and show you the numbers before you have to be, committed to doing the loan. And then 60% of the funds, that just goes back to they would let people access all of their money day one. And there's a small group of people, which kind of ruined it for everybody, that went crazy. They were impulsive and spent all of the money right away, and then of course had buyer's remorse. Like, what did I do? I just blew through all the equity. So FHA decided to tighten the reins a little bit and to let people use 60% of the funds that first year. And when you think about the amount, it's a lot of money. It's 60% of your home's value or the amount you qualify for. It's not a small amount. So if, you can use that how you wish the first year, and then after 12 months, the rest of it opens up. So that protects the ones that would be too impulsive and just would spend it way too quickly. Hopefully, if they had a year where it was sitting there, they would start to become more accustomed to it and think through, how they want to spend it, so.
Okay, great. So how do you receive your funds? That is a common question. Do I have to get monthly payments? What are my options? The money I qualify for, how can I access it? Well, there are different options. You can do a line of credit, which, I think a lot of people are fairly familiar with that because it is there's a traditional line of credit too. So essentially we say, okay, you qualify for X amount of dollars, we're gonna put it in a line of credit for you. And then you can request it as you need it. That way, if you don't touch that line of credit and that money's in there, you're not having to pay interest on it. You haven't actually accessed it. It's not part of your loan. So you can allow it to be in that line of credit and only withdraw it as you need it. That way you can reserve some of the equity left in your home. A upfront lump sum, so that's kind of what Melissa was saying, in that first year, you're allowed to get, a certain percentage upfront. You can take it all at once if you want. Monthly payments. If you're like, look, I know that I'm supplementing income and I only need X amount of dollars each month, then we can certainly set that up to where you receive a monthly check, essentially, every single month. And then a combination. Some people want a combination. They're like, I need $12,000 up front. I want to have monthly payments sent to me, but I also want to leave some in a line of credit in case I need it. We can certainly tailor this program to meet your needs.
Yeah, and the line of credit, that's beneficial if you some people want to just put their equity on demand. Basically, be proactive so that if you ever do have a situation, this cash that you have in your home that you can't access is already there for you. You go through the approval process one time, and then it's there for life, unless you were to call and say, close it, I don't want it anymore. It's never gonna expire. So it would be like us just saying, okay, you're approved for this amount, and it's gonna sit there, and if you need money, all you have to do is request it, and we'll put it straight into your account or send you a cashier's check, whichever you prefer. That's really neat, and I look back on what I went through with my dad, and I say, like, that would have been great. Even if we thought, he's good, he has enough income, bills are paid, we're good, it would have been really nice to have that set up, because when something happens, that's not when you want to run to the bank and be trying to do a loan. You want to do it ahead of time where you can think it all through, make your decision, and then it's there. So that would have been really nice. The other thing is, like Kelly said, it's not a loan yet. Until you withdraw the money, it doesn't go over to your payoff balance. It's just simply putting it there and available. And a lot of people compare it to a home equity loan, like a line of credit, and it's so much better, because I used to offer those too. This, if you did have to pull money from it, it normally means you need money. There's not enough, you have a need for it. And if you use it, you won't have a bill that shows up in 30 days, and now you gotta add that to what you have to pay. Because with the home equity loans, I used to see people take those out in moment of need, and then it would really hurt them because they already were tight, and now they've got another bill, and it's tied to the house, So this is a way for you just to have that money available. The lump sum is typically something that there's one that if you just want one lump sum, no line of credit, just give me what I can get. That's typically seen when someone has a large mortgage payment that we need to pay off, and all of the money they qualify for is going to be used to pay off the mortgage. We'll usually just do it as a one-time disbursement, pay off the mortgage, and then you're done. The monthly payments, you can set it up for, if you want it for 10 years or you want it for the rest of your life. There's lots of flexibility in how to do that. And one last thing about this is you can change it at any time. So that, again, looking back on my scenario, and a lot of customers too, the ability to have it set up and be able to call as your life changes and change how you have this structured is really valuable. Because if you set it up, for instance, to receive monthly payments for the rest of your life, and then you find out that you have a health issue, you might not live to be 105 or whatever, and you need more money, you could call and say, hey, if I take $10,000 out of this today, how many years would that shave off my lifetime payment, or how much would it reduce it? Or you could say, you know what, I've been getting all these monthly payments, it's starting to rack up in my savings account, I don't need them right now, stop sending them. And they'd stop, and you call back the next month, send it all, you can do whatever you need to do. It's the same pot of money, It's just like having money in your savings account. You could choose to pull it out little by little, or all at once, or nothing. So it's very, very flexible in your life.
Okay, and what can I do with the money I receive? I think we've covered this, in previous slides. Essentially, there are no restrictions. It is your money. You can do whatever you want with it. One of the guys at work will tell people, if you want to take it all to the casino and put it on black, we would obviously not encourage that. That is a terrible way to use your proceeds.
But we don't ask.
But the thing is,
You
you
can
can do it if you want. I mean, it's your money. This is your hard-earned money that you've saved in your home. It's equity that you have. You're accessing it. You can do what you want.
Mhm.
Okay, how much does it cost to get a reverse mortgage? And I'm not gonna read off the slide.
Yeah.
I just wanna essentially kind of sum that up.
So this is a mortgage loan. There are closing fees, just like any mortgage loan. We have to get an appraisal, we need a title company to insure it. We have to pay FHA, insurance policy premium to insure the loan. And then there's the origination fee. One nice thing about it is these fees now are very, very regulated. FHA says if you're gonna be offering this to seniors, this needs to be, monitored, that you're not charging an arm and a leg to do a reverse mortgage. So it ranges based on your appraised value and your loan amount. Again, our company, it's all bundled into the loan. We fully disclose it to you. We show you beforehand, this is what you're looking at, and make sure that that's, gonna be okay with you. And then also, we do have the ability to work with people that, offer the price on their fees. We worked really hard to get people that are gonna do the job right, but also are competitive on their pricing. So we work very, very hard to keep the costs down as low as possible.
What are my responsibilities with a reverse mortgage? So essentially, you don't have any monthly payments. You have to continue living there as your primary residence. You can't just move out. You have to live there for at least 6 months and a day of the year. You have to remain current on your taxes, insurance, and homeowners association dues, like we talked about. That's the main thing, guys, is if you get a reverse mortgage, you have to keep current on taxes, insurance, HOA dues. And then the loan balance will not become due and payable until you pass or no longer live in the home. Melissa, you want to go ahead and go over the
The end?
options? Yes, the end.
So we talk a lot about when the loan gets paid back in the end. The end is two different scenarios. It's either if you pass away, or if you decide you want to sell your home. You no longer want to live in the home permanently. So if you pass away, your heirs will have up to 1 year to decide what they want to do, to kind of get their ducks in a row. They could choose to either sell the house, pay back what portion of the loan you borrowed, and keep the rest as their cash profit. They could go and get their own loan on, to refinance your loan into their name, or they could choose to walk away. If you ended up borrowing all of the money that was available over the years, and keeping in mind that increases as you age, so you could potentially borrow all of your home's value, especially if homes were not increasing in value. If something were to happen where home values go down or don't go up and you borrow a lot of money, and in the end, the amount you owe on the house, on the loan, is more than what it could be sold for, your heirs might not want to have anything to do with it. If it's not going to make them money, they don't want the house, they could just hand the keys over to the bank after they get what they want out of it. So basically, the thing about it for me is having a full year as an heir would be huge. I'm sure everybody's lost somebody before, and you don't usually right off the bat feel like going in and dealing with, at least for me, when my dad passed away, I didn't want to go into his house day one and start cleaning out his house. I was planning a funeral and that kind of thing. I was under pressure because he had a mortgage. If you have a mortgage today and you passed away, your bank's going to require that payment be made no matter what. They say, so sorry for your loss, but it's due. And so having a year to sit back and say, okay, I don't have to worry about this loan. I can take my time selling it and get a good price for it. Or I can go and shop around for a mortgage loan and see what I can get there. Or I can just clean it out when I'm ready and give the keys to the bank. There are people that do it for that reason alone. Kelly and I were talking on the way up here about someone who called. He was financially wealthy, independently wealthy. He was doing great, but he did it for his kids. When his father passed away, He got stuck with the house for 3 years on the market and was continuing to have to pay the mortgage, the taxes, the insurance. It wouldn't sell, and he was in another state. And so he called and said, I do not want my kids to have to go through that. I'd rather do this, write them a check for their inheritance and say, when I'm done, you guys just give the keys to the bank, don't worry about it. I mean, now if they wanted to sell it, if they thought they could and make more money, they could, but they would not have that burden if they couldn't, so.
They can just turn it over, walk away, and they're not left with any bad debt.
That's what the FHA insurance does. So if the house cannot be sold for enough to repay the loan, it covers the difference. And it will pay back the bank for whatever leftover there is. That means if even you had $1 million in your checking account that you left to your kids, but your loan was $20,000 short after it was sold, we took a loss, FHA would pay that difference, and nobody can touch any of your other assets, because that's what the insurance is for.
Okay, so I know we're over on time. Essentially, what we'll do is open it up to questions now from you guys. So,
Well, let's go to a satellite location. Carruthersville, let's start with you first. I know you're on. Carruthersville. Going once.
The program was explained really nice, and we were late. We didn't understand, we didn't get a chance to register. But however, no one have any questions here. I don't know how come we are so smart.
wow, good job, guys.
That sounds like Miss Bernann Thompson. Is that you?
That's pretty.
All right. I know that voice. All right, thank you. Well, we're going to move up to Sykeston. Sykeston, do you have any questions? Miss Rosie, Sykeston's on.
Okay, yes, we're on. This is Jesse Lane from Sykeston. You were talking about the reverse mortgage. What if you don't have a mortgage, but yet need a repair loan?
Okay, so the
A
question,
loan for-
that's actually a good question. She asked, what if you don't have a mortgage and you just need the reverse to do repairs on your home? Not having a mortgage is completely fine. That just means that the amount of money you qualify for can be used for everything else, not paying off a mortgage. So that means there would be money available to do repairs on the home. It would depend on what type of repairs there are. So we would need to see if they fall in the category of safety and soundness, or if they're just things that you would like to do that you call repairs that are more cosmetic as far as FHA is concerned. If they're just repairs that you want to do, then that's fine. You can do them when you get the money, however you'd like. If they are something that would be under the safety and soundness, then we would have to work through how we could do that. There's different options on how to address the repairs. Sometimes, like I said, you can get some of the money to go ahead and do that, and then the appraiser comes back out after they're done to certify that it's been done, and then they release the rest of your money. But it really is case by case. So I would recommend, if you're interested, just to contact me and we can talk a little bit more about it, and I can go over exactly what it would look like in your, particular situation.
Good question. Are there any other questions?
So, yes, just a minute, please, go again. Okay. My age is 81, yet I own the house that needs repairs. Would that make a difference?
That actually would be very beneficial. I mean, that means that there's going to be a significant amount of money available to you, and that definitely helps when we're looking at needing to use some of that money for repairs. So that'd be good.
The main thing is when getting the reverse mortgage approved, so when the underwriter approves it, they want to make sure that the home meets just minimum HUD requirements. So that's when Melissa's talking about being safe and sound. It's according to HUD's requirements. So if it's something that they think does, it's like black mold everywhere, or like the roof is falling in, something like that, then they would require that it's repaired prior to closing. But we work with lots of companies who can do these repairs, and then they'll wait to be paid essentially once we close the loan, and then we can pay them with the reverse mortgage proceeds. So, we have done things like that before. It's just like Melissa said, case by case. And we really need to see the home. We need to have an appraiser's opinion. We need to send an appraiser out, have them inspect the property, and then tell us if it meets HUD requirements or if it doesn't. If it doesn't, then we can talk about options at that time. Okay, any other questions?
Yes. I understand that the amount is, one is able to borrow overall is calculated by age, interest rate, and the value of the home. What role does equity play in this ability to borrow? The equity amount?
So the amount of money that you qualify for needs to be enough to pay off your mortgage. So as an example, let's say your house is worth $100,000 and you qualify for 50%, so $50,000. You have $50,000 that you qualify for, so you would need to have at least 50% equity in the home, meaning the mortgage that you need to get paid off would have to be $50,000 or less in order to get the reverse mortgage, because the funds you qualify for need to pay off the mortgage. Does that make sense? Okay.
And if you don't have a mortgage, then it doesn't matter. You would just get that $50,000 to do whatever it is you want.
So this would not be a good loan for someone who they owe as much as their house is worth. Some people will call me thinking it's a program for people to do to, help when they're upside down on their mortgage or something. This is not a good program for that.
So let me make sure I heard you correctly. So if you owe $100,000, you're eligible for $50,000, then your balance has to be less than that $50,000.
Correct.
It's appraisal of $100,000, you qualify for $50,000, and your mortgage has to be less than that $50,000.
Correct.
Unless you want to bring money to closing. So here's an example. When I was a loan officer, I did work with a client, a customer of mine, who they qualified, let's say their home was worth $100,000. They qualified for $60,000. Their mortgage payoff was $65,000. So that means they have to bring $5,000 of their own money. So to pair with the reverse mortgage proceeds, now we can pay it off. You ask yourself, why would they bring money? Well, because they were gonna have a balloon payment due. They had been paying interest only for so long, and pretty soon they were gonna owe $40-some thousand. That's a lot of money. So they didn't have $40-some thousand, but they had $5,000. So they're like, hey, I'll bring $5,000. You guys bring 60 together, we'll pay off the mortgage, and I don't have a payment any longer. So that's an option. You can bring your own funds if it makes sense for you to do that.
Mm-hmm. And a lot of people do look at, well, I could easily pay myself back with not having a mortgage payment, pretty quickly.
Good, Sarkston, any other questions?
Yeah.
I have one. The startup fees you all were talking about, it could be as much as up to $6,000, is that what I heard?
Mm-hmm.
It could be as much as up to $6,000, that'll be the most.
Up to 60. So it's a percentage.
Closing
Okay, closing costs.
Yeah, so that is the origination fee that is restricted by FHA. It can be from $0 to $6,000, and that is based on the home value, appraised value. That $6,000 is what you see when we look at homes that are worth probably
$425,000 or more.
Yeah, so those are large.
Anyone have
That's not
that? But there are other fees too.
But the other question to that was, I know that I heard you all say earlier that your credit score was not involved with this really, it didn't really matter. However, that is a part of what you all do. You do a credit score check anyway. What's the purpose of that?
Well, we do pull your credit because we need to know what your monthly obligations are. We need to make sure that we're doing our job and we're doing this to help you, not put you in a situation where you just don't have enough money to make it. So we need to look at what's reporting on your credit bureau as far as minimum payments. Like if you have a credit card or car loan, we need to look at your income, subtract what your current payments are, and then also subtract your taxes and insurance to make sure there's enough money left over that you would be able to live on that.
Yeah, so we do not look at the credit score, we bypass that portion of the credit report, but also in the credit report, we do look at 2 years of payment history. So that's something that they will look at to see how many 30-day, 60-day, 90-day late payments have you had within the last 2 years. If you had late payments, there are sometimes extenuating circumstances. I had a client who had been late numerous times on multiple credit lines, but it's because he had a heart attack. He went to the hospital, he was in rehabilitation. No one was there to take care of his finances while he was in the hospital. So then when he got out, he got better, he had to play catch up. And that's hard to do. You know, when you get so far behind, it's hard to play catch up. So we could explain that to the underwriter, saying, this is his situation, this is what happened. Now he's doing great, he's finally catching up, he's getting his feet back on the ground, and you know, we were able to move past that without any issues at all because we could explain it. So we're not looking at credit score, we're looking at payment history and monthly obligations.
And there's a lot of extenuating circumstances. From what I've found, majority of the time when you see someone who is late, it's not because they woke up that day and decided to not pay their bills. A lot of times it's the loss of a spouse or loss of employment. So we work really hard, that's what I do, is work one-on-one to understand what your situation is and how we can see if this is gonna be something that makes things better for you.
Thank you, Sykeston. Let's move over to Charleston.
Charles, if we don't have any questions, however, we did enjoy and we learned several things from the presentation.
Great.
Thank you.
All right, thank you, Charleston. Well, let's move up to St. Louis.
Questions, anybody? Questions? No, I don't have any questions.
No questions. Thank you, St. Louis.
I have a question, but it's not related to reverse mortgage. What if your home is paid for and you need this offer that you giving if it's a reverse mortgage? I don't have a mortgage. My home is paid for. It needs no repair, anything.
So
and I would like what my
Yes, if you do not have a mortgage, that is wonderful. It's actually just as many, it's the same, you know, some people have mortgages, some don't. If you don't have a mortgage, that's even better, because that means that we don't have to use part of the money to pay off your mortgage. You're free. All the money that you have, you can use however you want. So this is just a way for you to turn that equity in your home into cash that you can use safely. That you're not signing up for anything that could hurt you, like you're gonna have a payment you've gotta make now. It's just allowing you to borrow some money against the house that you'll never have to pay back during your lifetime if you don't want to. And you can use it however you want.
and that's what I'm interested in.
Well, just,
My home need no repair, taxes is all up and everything.
yeah, that you would be a perfect candidate. That's actually easier for us when there's not a mortgage. It's not hard when there is one, we just have to pay that off first, and then if there's money left over, you can use it how you want, but if there's not, then it's just paying off the mortgage. So when you own your home free and clear, this is just pure cash for you to do what you want with. And you can always contact me. We put my business cards in the folder, and that's my direct line. I talk to people all day, every day about their situation and tell them, you know, very quickly, this is how much money you'd be looking at and how you could, you know, use it, so.
Good question.
Thank you, St. Louis.
I have a question. Another question.
Go ahead.
My dad who's responsible for paying back the loan?
Well, no one is responsible for paying it back so if nothing, if you had no heirs, you didn't want to leave it to anybody, then after the time had passed, the bank would take it and sell it to recoup the loan amount. Even if it wasn't enough to pay it back, that's no problem, FHA would pay the difference. But most of the time, since we're not giving you the full amount of your home, we're not buying the house, we're just letting you borrow a portion of it, there's gonna be money left on the table for your heirs. So if you wanna leave it to a family member, then they will have a year to decide if they wanna sell the house and pay off the portion with the money they get from selling it. They could pay back the portion that you borrowed and keep the rest as cash. Or they could always go and, pay off the loan with their own loan or money and keep the house. But if there is no one that you want to leave it to, then that's no problem. The bank will take care of it.
Any more questions from St. Louis?
No, you did good.
Thank you. Good ladies. All right, Missouri, questions?
I've always heard that once you die, that if you have, that automatically all of your debts are canceled out. So are you saying there's a clause in this loan that says if you pass away, the heirs have to pay back that loan?
The heirs do not have to pay back the loan. It's just giving them the ability, basically, if there's money on the table, because your house is worth more than what you borrowed, it can go to them. So if they don't want anything to do with the house, if they don't want to keep the house, they don't want the cash, there's no cash to be made, they don't have to do anything. There's no debt that they're gonna say, you have to pay this back.
Rather than a forward mortgage, if you had, let's say right now, I have a mortgage on my home, and I have 2 children. So they're not of adults yet, but let's pretend they are. Let's pretend I'm older and they're older and I pass away, my husband and I both pass away. Then my children do owe my debt. So I have a mortgage, that doesn't just go away. The bank that holds my loan isn't like, well, they're gone, so we're gonna forgive the loan. No, they will go after my estate. So if I have assets, they're gonna go after my assets. They're gonna go after my children to pay off my debt. Same thing with all financial obligations. Your children will have to pay that. Unless you have it set up a certain way in your will or a life estate or a trust, things like that.
And
But
it's not like they're gonna go after your kids and say, you better pay this or else, but what they're saying is, they're gonna use all of what you had to repay it first. So if you had money, like, if you passed away and you have a mortgage, if that can't be paid, then they'll foreclose on the house, the bank will take it over and sell the house to repay themselves. And even if they make a profit, that profit is not gonna go to your children. Does that make sense? So the bank isn't gonna step in and say, well, she passed away, no one's making the payment, we're gonna sell the house, but you can get the extra. That's not how it works. They just come, they take the house, and they're not gonna call your kids and say, well, now you owe us 30 grand. But if you left them other money, like if you had life insurance money or you had money in an account, they can go after your estate, like all your money. So the reverse mortgage would at least give them the ability, which they have the same ability if you have a regular mortgage, to sell the house. If anybody, if your parent passes away and they had a mortgage and the house is worth double what they owe or whatever, no matter the math, you have the right to sell the house, pay back if you're the heir, to pay back the loan, take the rest. But the difference with the reverse is it would give them time to do that without having to make the payment in the meantime. So they'd have a year to do that.
And the other difference is the reverse mortgage is government insured. So since you pay that FHA insurance, they won't go after your estate.
Yes.
So like a forward loan, like she said, will go after the estate to collect the money that's due to them if there is more after they sell the
life
home.
insurance, cash in the bank, that kind of thing.
But
So
with
in
the
this scenario,
mortgage-
even though if your heirs didn't want to sell the house, and they did the same thing, they come and they take the house, they foreclose to pay themselves back, whatever else you have can be left to them. So even if you had $1 million in your checking account, and they had to sell your house, took a loss, they sold it for $100,000, you owed $120,000, so they were short $20,000. even if they knew, well, she's got $900,000 here, she left her kids, they could not touch that because it's FHA insured. It covers the difference.
Thank you.
Mhm.
Any other questions?
We do have a question at Crothersville.
All right.
Interest rate, how do you figure out what the interest rate would be on the loan?
So it's kind of like a regular mortgage loan. I mean, today it's in the 4% range. It's just gonna depend on when you do it, just like a regular mortgage. You know, right now interest rates are low, so it's nice because it means that you can get more money, because the interest rate is low, so they don't need to have it, more equity left, you know, for the payoff balance. But you would just, I mean, if you ever want to know, it can change every day, so I can't tell you exactly, you know, it's not just going to be a certain rate no matter when you do it, but you can always call me for a quote, like just to see what is interest rates and how much could I get today. I mean, I never mind just giving you information, even if you don't end up doing a reverse mortgage, but you're curious on, you know, what the rate would be, you could call me on my direct line and I can tell you in a split second what it is that day.
Carruthersville, any other
One
questions?
more part to,
Go ahead.
sorry, one more part to the question, credit score, that also has something to do with the percent, no, yes?
Nope.
Nope.
It's either, as far as credit goes, it's either you qualify or you don't. It's not, well, your credit's good, so you're gonna get a better interest rate or anything like that. And as far as qualifying, we just wanna make sure that you're gonna be able to do this, you know, that you're not gonna take out the reverse mortgage and not pay your taxes and insurance.
The amount of money you qualify for is strictly based on your home's value, your age, and what the current rates are at that time. What I mean is, you know, if you are 62 years of age and you have a $100,000 home, you're gonna qualify for less money than if you were 90. You're gonna get more money based on your age. Same thing with a home. If you're 62 and own a home of 100,000, or you're 62 and own a home that's worth 400,000, you know, 50% of 100,000 versus 50% of 400,000 is quite a bit different. So that home value is going to give you more money too, if that makes sense. So it is truly just based on age, home value, and the current rates. Credit has no bearing on how much money you're going to receive. It's essentially, we look at credit to see, are you a good candidate? Are you not a good candidate?
And one more thing to add on that, when I said it's either you qualify or you don't, there is an alternative or another option if you don't. Like, so let's say you've just struggled, you're not good at remembering to pay your insurance or your taxes, and you just forget. We would, if you qualify, we would ask you, would you like to do the reverse mortgage if we pay your taxes and insurance? And what we would do is take a portion of the money you qualify for and hold it aside so that every year when that's due, we can pay it from there. So you always have that second options. We're not gonna say too bad. We'd say it looks like you've had some trouble and we're afraid you might have some trouble again. So if you wanna do this, we need to make sure it's okay with you that we pay these for you.
I have a question.
Mm-hmm.
Does it matter what state you live in? I mean, what city you live in?
It does not matter what state you, or city you live in. I'm licensed in all of Missouri and actually nationally licensed. So we have different loan officers for different states. It's actually really unique that we're here in Columbia. With reverse mortgages being just for people who are 62 and older, you don't find local locations all over the place for people to go in and do it. So our company actually serves all of the United States, and we have different people for different states. So if you happen to contact me and you were looking at a place outside of where I'm licensed, I would have a coworker right there that I could have you speak with that would be licensed where you're looking. Mm-hmm.
I have a question, I guess more of a concern
Uh-huh.
than anything. But you being living in Columbia, it was a situation that happened about a year ago. It was all over the news about reverse mortgages. And where this lady's husband had passed away, they had a reverse mortgage. And he was a lot older than she was. And from the pictures on the news, it seemed like they lived on a farm, had a farm. But when he died, she lost everything.
Mhm,
and
and
was
that,
forced to move out of her home.
that was something that was, changed
You want
use.
to restate your question?
Yes, sorry. So she had heard on the news that a couple, a husband and wife, had a reverse mortgage. The husband passed away and the note became due, so the wife lost the home
And was forced to move out.
and was forced to move out. So FHA used to leave it up to the borrower to decide, do you want to put both people on the loan or just one? And a lot of times when you had a situation, because the older you are, the more money you get, when you had a big difference in age, and we would say, okay, well, if you put your wife on it, you're only gonna get this much, but if you're both, or if it's just you, you would get this much. And then let them decide. A lot of times people would say, let's just put the older person on it. And they would say, yeah, we've talked about it, we have a plan, you know. And as a loan officer, as a bank, you can't assume someone's lying or question them. But needless to say, it was left, the rules were, it was up to the individual borrower how they wanted to do that. And it was a huge problem because more often than not, it wasn't truly discussed amongst them as a couple. And you did hear these horror stories of people, they lost their husband and then lost their home, you know, how awful that would be. So FHA stepped in and said, this has got to stop. It's no longer going to be allowed to decide if you want both of you on it. You both have to be on it. And there's a lot of people that get very angry about that. Now, when we tell them, I'm sorry, if you're legally married, you've got to put your spouse on it. I'm sorry it's going to cut into because they're younger, but it has to be that way. So now that has been solved. It is impossible. If you're legally married, you're both going on it, and that way if something happens to one of you, nothing changes. It's both, you're both in there for life, and then they even have an option for people who only one spouse is 62 and the other's younger. They still have to go on it because they're married, and we never want that situation to happen again. So now if you have someone who's under 62, they're on there as a non-borrowing spouse, so they're still protected as a spouse that they would be able to live in the home forever the rest of their life. But they wouldn't have access to pull more money out if they were under 62 when the loan was established. So that's been solved, and it was a big problem. Of course, again, a small portion of people kind of ruin it, you know, for the program in general, because you don't have to hear that more than once before you're like, you know, I don't want to touch that.
I heard that.
Yeah, that's really scary.
And that is scary. And you know, with, like anything, you hear more negative than positive. You know, we get letters all the time from people that are like, thank goodness I did this. Like, I have been able to stay in my home. I don't have the burden of my medical expenses. I don't have to worry about, you know, meeting bills every single month. I don't have that stress. I can truly live out a better quality of life for the remaining years. But you don't hear about that in the news. You know, you hear about these situations where people, these one-off situations or unique things that happen that are scary. But this program has changed so many times. In the less than a decade I've worked at the company, it's changed like 8 times. You know,
But it's
to
always
make
in
it
an
better.
effort to put security nets in place so that an individual can't hurt themselves or their spouse or whatever. So it's just, sometimes it's unfortunate because they take the choice away from the borrower, but in overall, it's good for the program and inevitably good for them because you just can't make a mistake anymore. I mean, they have it regulated, so you don't have that option.
One more question from Mid-Missouri. Any more questions?
So what if you own the home, you own your home, but you didn't really have, equity inside of the home, how would that?
Well, you should. So equity is what your house is worth after you pay off what's owed on it. So if whatever your house is worth, if you don't owe anything, then it's 100% equity. Equity is the portion that you own. So if you own the house and it's worth $100,000 and you owe $50,000 to the bank, the other $50,000, the portion that you own, is your equity. So for you, whatever your house is worth, so let's say your house is worth $100,000, then you have $100,000 in equity. You have 100% ownership, 100% equity.
But if you owned it, just outright owned it,
Yes.
you didn't have to pay out a mortgage or anything.
Correct.
Then that means that the money you would qualify for, the amount we'd let you borrow, you could do whatever you want with. You don't have to use it to pay off a mortgage because you don't have one. You can just use it however you want the cash.
But if supposing your home needed some repairs done to it, I mean, does that matter at all?
Yeah, you could use the money then to repair the home, and depending on what type of repairs they are, if they were something that was a big, healthy, like a safety concern, then it might be something that you would have to get done before we could get the loan approved. And in that case, we would work with you to try to find a solution. Like Kelly said before, there's some companies that we are aware of that will go ahead and come and do the work and then let us pay them at closing with your loan proceeds. And there's other situations where they'll just hold some money aside until they can see the repairs have been done and then release the rest of it to you. So there's always options.
They were the experts. Please join me in a round of applause. I'll hold that. Mr. Onesimus, go ahead. Final question. You're going to get 2 rounds of applause.
Thank you.
We have one more question that's absolutely...
You said that one can get a reverse mortgage even if they do not have a mortgage.
Correct.
Is that technically correct?
Yeah.
Yes, uh-huh.
What was the question?
The question was,
If you do not have a mortgage,
Correct.
you can still get a reverse mortgage?
Mm-hmm.
How, can you explain?
So, let's say,
So
the question was, if you do not have a mortgage on your house, can you
Okay.
still get a reverse mortgage, and how does that
Can
work?
it still be called a
Okay.
reverse mortgage?
So, think about this, when you do a regular mortgage, you borrow the money to buy the house. Okay, so the bank gives you the money to use it to buy the house, and then you pay it back. With the reverse mortgage, you borrow the money to do whatever you want with. You're taking out the loan again, but the loan does not have to be paid back until you no longer live in the home. So you get that money, and you can use it however you want. And that's why sometimes people call it a reverse, because if you choose to receive a monthly payment, so let's say you got your loan originally and you paid it back over 30 years, you sent a payment for 30 years. This, you could reverse it. Take your mortgage back out over 30 years. We pay you a check every month that you're receiving funds. That's one way to do it. And that's why I think they call it a reverse, because you're reversing it, getting your money back, and you're slowly, taking out your loan again. But it's coming to you this time.
yeah. Yeah, that's a good question. So you're not required to have a mortgage to get this. Another reason that I think they call it a reverse mortgage is because with a traditional forward loan, so traditional forward mortgage, like Melissa said, you take out money, and over time, that loan balance is going to get less, right? It's going to reduce, because you're making payments every month. So you're paying towards that interest, you're paying towards that principal, you're chipping away at your loan. With a reverse mortgage, you pull out the money, and you don't have a monthly payment, but there's interest that still accrues, right? There's still interest that's going to accrue. Nothing's free in this world, it's not free money, so interest does accrue. But you're not making a payment. So instead of that loan decreasing over 15, 30 years, your loan is going to increase over time because you're not making payments. Now, if you want to, you can make payments.
Yeah, you do get a monthly statement
Yeah.
every month. It'll say nothing's due, but if any time you want to pay towards it, keep
You
it down
certainly can.
or pay it off, you can. There's no penalty for that.
Yeah,
so.
so you can pay it. So that's also why they call it a reverse mortgage, because it's working in the reverse way. Instead of you decreasing your loan over time, your loan is going to increase over time, which is why they also leave equity in the home. You only get a portion of your equity, because they want to leave equity so that you're not over-financed day one.
Yeah.
That you don't now owe more than your home is worth. That there is equity left in your home to allow for that growth, okay?
Thanks.
All
You're
right.
welcome.
Please join me again. And a big round of applause.
And thank you guys. You guys were great. Everyone had some wonderful questions. You guys were really engaged, and so we appreciate that. And thank you so much for allowing us to be here and just speak to you. If you have questions that were unanswered, or maybe if we were not clear enough, feel free. Check out, if you're online, check out our website. It's a really great resource. That's something our company prides ourselves on. We want to be a resource for you without having to get your business first. We want to provide you with all the materials and information so that you can make an educated decision. But you can also call Melissa if it's easier sometimes. Just pick up the phone, call her, and she's happy to walk you through any questions or concerns that you have. Okay? Thanks.
And I also wanted to add, they brought goodies, and we love goodies. There's a cooking conversion chart that they brought in satellite locations. I will mail those to you, but I want to thank you all for doing that because this is really great. I mean, you're very informational as far as your folders and also something extra, so thank you, ladies.
You're welcome. It's a magnet, so you can just put it right there on your fridge and you know your measurements.
Well, let's disconnect from our satellite locations. I hope that you completed your pre and post test, which was created by these ladies. All righty, starting with Carruthersville. Goodbye, Carruthersville. Bye. Let's move up to Sykeston. Goodbye, Sykeston. Bye. And let's move over to Charleston. Goodbye, Charleston. And let's move up to St. Louis. St. Louis. Goodbye, St. Louis. Andrew.
Anything else?
Thank you all for attending.